Welcome. Where did the income statement come from? Well, the Industrial Revolution added a bit of complexity. No longer were there just traders going on trading missions, but now we started to make things, and that making of things caused a need for more resources because factories were being built, and thus the rise of the corporation happened. And when the corporation rose, they said, not only are we interested in each individual deal, but we want to know what's going on for the period of time. Because when you take on stockholders, the stockholders are saying, well, it's nice that you keep doing business, but I would like a little return every so often. In other words, they want to be paid dividends. Thus, there needed to be some way to measure for a period of time, like a year, what the revenues were for the business and what the costs or expenses were that matched against those revenues for the business, so you could come up with some sort of bottom line or net income that you could then say, well, how much of this net income am I going to reinvest into my business, and how much of it am I going to pay out to my stockholders in dividends? Because of that, and also because property, plant, and equipment lives a lot longer than a year, we had to figure out how to spread the cost of that property, plant, and equipment over its useful life. Thus, depreciation came into being. And you know, it took about 100 years for them to decide how to do depreciation. So those declining values in costly, long-lived resources that they needed to be able to chunk that value over their usefulness is what depreciation is. Also, with a corporation, there's limited liability for those shareholders, and you need to be able to communicate who's responsible for what. So yes, we have the balance sheet that gives us a snapshot of a financial business at a moment in time, but we need to know what goes on between those snapshots. So you may have a balance sheet the first day of the year, you may have a balance sheet at the last day of the year, but you really want to know what happened during the year and to be able to communicate that to shareholders. And that's what the income statement does. And I wish to share with you this quote: making the greatest quantity possible in a given period of time was said by Josiah Wedgwood. And Josiah Wedgwood made China. And Josiah Wedgwood's fortune was fortunately funded his nephew's trip around the world in a ship called the Beagle. And so you could say that not only did accounting was it the second oldest profession, but it also gave rise to modern science because that nephew's name was Charles Darwin. The other thing that happened around the time of the Industrial Revolution is we needed to start trading these stock certificates in these various corporations. So the stock markets and capitalism and financial markets came into being because business never ended. It just kept going, but we needed to account for it every year or every period so people could see kind of what was going on. So that's where the income statement arose. Now, that means that our accounting equation is getting expanded. We know that the balance sheet is assets equal liabilities plus shareholders' equity, and that's at a moment in time, and that the income statement covers a period of time. You can think of the income statement almost like a cost-benefit analysis, because the costs or expenses is what was used or consumed, if I can spell, of those resources in order to generate revenue. The reason you're in business, sales, income. So if I look at the income for the period of time and compare it with the costs that were used or consumed to generate that revenue, the difference is called the net income. Revenue minus expenses equals the net income. And the great ratio you can do off of this is called the profit margin ratio, and it's to take the net income divided by the net sales to kind of see how much of that revenue as a percentage translated into the bottom line, the profit. Other things that you need to know about is at the end of the period, you take that net income and it gets closed into the shareholders' equity and becomes part of an account called retained earnings. And that's why the balance sheet is made at a moment in time and the income statement covers the period of time. More on that soon. So here's some basic income statements. There's two basic formats. There's something called the single step, where all the revenue is together and all the costs are together to come up with income before income taxes, income taxes and net income. Or you can use what's called the multi-step, where you divide up the expenses or the costs that pertain to the product that is being manufactured, the cost of the goods sold. Those are product costs that went into making the products that period. And the expenses, called the operating expenses, that are non-product expenses and have more to do with the selling, the administrative, and the general expenses or costs that are consumed in the business. So in a multi-step, you divide up the product expenses and the period expenses, or the selling, administrative, in general, versus the single step, you lump them all together and just call them costs and expenses. Notice that the key terms or the key numbers on both of these are the same. You want to know what your revenue or your sales are. You want to know what your cost of goods sold are, or your cost of sales. If you're a service business, sometimes you call it cost of sales. You want to know what your operating expenses are. You want to know what your profit is from the day-to-day operations of your business, meaning the operating income. You may have some other revenues and expense items. And then you want to know what the income tax expense is. This is not the amount of income taxes you pay, but this is the amount of income taxes that are computed based upon this financial statement known as the income statement, and that comes up with the net income or the net earnings. So this may look familiar. You, a video or so ago, took a quiz on finding these numbers, the treasure hunt in using Amazon. And for 2014, you figured out what the revenue or the net sales was. You figured out what cost of goods sold was, what operating expenses were, which you had to add up, what the income from operations was, what the other revenue and expense items were that didn't have to do with the day-to-day business, and what income taxes were, provision for income taxes. Notice they have some other kind of weird items. That's because Amazon was acquiring a lot of businesses at the time to come up with their net income, and since it's in brackets, they had a net loss. So if I computed the profit margin for 2014, it would be a sad profit margin because it would be a negative percentage because it was a net loss, not a net income. Well, fast forward, here's 2013, 14, and 15, and you can see that they still had a lot of seesawing going on but their sales continue to grow every year, but their net income was a seesaw. Profit, loss, profit. Continuing on, when it became Alphabet, and remember they switched the ways you look at these, so 2016 profitable, 2017 profitable, 2018 profitable. So what I would like you to do now is, can you find the numbers again? And to look at how profitable this business is for the last 3 years. So I would say pause right now and figure out the numbers. Welcome back. Let's look at the numbers for 2018. If I was looking for total revenue or net sales, I would see that in millions, it's 136,819. 136,819. The cost of revenues is 59,549. The operating expenses, if I add up all of these, comes to 50,949, so that my income from operations is 26,321. My other income and expenses is 85.92. My income tax expense is 4,177, and my net income is 37.36. If I compute the profit margin in 2016, the profit margin is 21.6%. Remember, that's taking the net income and dividing it by the total revenues. In 2017, if you compute it, it goes down to 11.4%. But in 2018, it rises again to 22.5%, or 22.5 cents of every sales dollar or revenue dollar is profit. Is that good? Is that bad? Well, it depends. It depends on what you're comparing it to. And that's a lot of what analysis is about, is computing these ratios, but not only computing them, but figuring out what the story is. So, what did we learn? We learned about the income statement, and we learned why the income statement arose in the time of the Industrial Revolution, because of many reasons. So, until next time, happy accounting.